Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about VERALTO Corporation Annual Report. VERALTO Corporation offers a diverse range of businesses and services worldwide. The company operates through two main segments: Water Quality, WQ, and Product Quality and Innovation, PQI. The WQ segment provides precision instrumentation and water treatment technologies for various applications, including residential, commercial, municipal, industrial, research, and natural resource sectors. This segment also offers water solutions such as chemical reagents, services, and digital solutions. The PQI segment is focused on product quality and innovation, offering a wide range of products and services. These include marking and coding for packaged goods, software solutions for digital asset management, marketing resource management, and product information management. The company also provides inline printing solutions, design software, imaging systems, color management solutions, and color standard services. VERALTO Corporation serves various industries such as municipal utilities, food and beverage, pharmaceutical, and industrials through its brands including Hatch, Trojan Technologies, ChemTreat, Videojet, Lynx, Esco, X-Rite, and Pantone. The company's products and services cater to the needs of these industries, providing them with innovative solutions for water quality management, product marking and coding, and color management. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of any company can fluctuate due to various reasons. One major factor is poor financial performance, such as declining revenue or increasing losses. This can lead to a decrease in investor confidence and subsequently lower the stock price. Additionally, changes in market trends, industry-wide issues, or global economic downturns can also impact a company's stock value. Another reason for a drop in stock price could be due to internal factors such as poor management decisions, lack of innovation, or failure to adapt to changing market conditions. This can lead to decreased investor trust and ultimately lower the stock price. Furthermore, external factors like regulatory issues, lawsuits, or negative publicity can also negatively impact a company's stock value. In some cases, a drop in stock price may be due to industry-wide trends or macroeconomic factors that affect multiple companies within the same sector. This can make it challenging for individual companies to maintain their stock prices despite their own efforts to perform well. VERALTO Corporation market capitalization of $23 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that VERALTO Corporation holds a significant advantage in their industry. VERALTO Corporation trades at a lower price-to-earnings ratio of 25 times and a higher price-to-book ratio of 7.45 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be categorized into several key areas. Firstly, customer demand for new and enhanced products and services has been a significant contributor to revenue growth. The acquisition of over 85 businesses has also played a crucial role in enhancing product capabilities and expanding into new markets. In addition, the expansion of existing brands through innovation and digital solutions has driven growth. Increasing demand for water analytics and treatment solutions, due to growing concerns about water scarcity and safety, has also contributed to revenue growth. Furthermore, a diversified business mix by geography, strong presence in high-growth markets, and strategic investments in emerging markets have all contributed to revenue growth. The company's geographic diversity has allowed access to new markets for products, while positive pricing actions and higher volumes have also driven revenue growth. Geographic expansion in developed markets and high-growth market growth have also been significant contributors to revenue growth. On the other hand, the primary drivers of revenue decline are relatively limited. The loss on product line dispositions, net, has been a significant contributor to revenue decline, with losses recorded in 2025 and 2024. Additionally, impairment of equity investments has also contributed to revenue decline, with impairments recorded in 2025 and 2023. Overall, the company's revenue growth is driven by a combination of factors, including customer demand, acquisitions, expansion of existing brands, and geographic diversity. In contrast, revenue decline is primarily driven by losses on product line dispositions and impairment of equity investments. Net income experienced a significant increase from $833 million in 2024 to $940 million in 2025, marking a growth of $107 million. This upward trend is also evident when comparing the net income figures for 2023 and 2025, which increased by $101 million. The improvement in net income can be attributed to various factors, including revenue growth driven by new product launches and expansion into emerging markets. Profit margins also underwent a notable change during this period. Operating profit margins saw an increase from 24.5% in 2024 to 25.4% in 2025, while the gross profit margin rose from 59.7% in 2024 to 59.8% in 2025. The improvement in operating profit margins can be attributed to cost reduction initiatives implemented across the organization, including supply chain optimization and headcount reductions. The reasons behind these changes are multifaceted. Revenue growth was driven by new product launches and expansion into emerging markets, which provided a significant boost to net income. Additionally, cost reduction initiatives helped improve profit margins, while improved pricing power due to increased market share and competitive positioning also contributed to the increase in net income. The company's financial performance indicates a consistent trend of generating positive operating cash flow. As per the data on page 51, the net cash provided by operating activities has been steadily increasing over the past 3 years. In 2025, the company generated $1,077 million in operating cash flow, up from $875 million in 2024 and $963 million in 2023. This upward trend suggests that the company is effectively managing its operations to produce a significant amount of cash, which can be used for various business purposes, such as investing in new projects or paying off debts. The company's debt level has shown mixed results over the past year. While page 19 indicates a significant increase in debt to $2.7 billion as of December 31, 2025, other pages suggest otherwise. Page 46 states that long-term debt decreased from $2,599 million in 2024 to $1,973 million in 2025. However, page 78 contradicts this statement by showing an increase in the carrying amount of long-term debt. Additionally, foreign currency-denominated long-term debt increased from €513 million in 2024 to €584 million in 2025. In terms of interest expenses, there is a clear decrease. Net interest expense decreased by 15% from $113 million in 2024 to $96 million in 2025, as stated on pages 33 and 47. This reduction in interest expenses can be attributed to cross-currency swap derivative contracts, according to page 82. Overall, the company's debt level has shown inconsistent changes, while its interest expenses have decreased significantly over the past year. The performance of various segments and regions in the market can be analyzed based on the extracted summaries. Developed markets such as North America and Western Europe showed significant growth with an increase in sales of 5.9% and 8%, respectively. In terms of specific product segments, water quality and product quality and innovation performed well, with revenue increases of $183 million and $127 million, respectively, from 2024 to 2025. On the other hand, certain regions such as Asia, excluding Japan, Australia, and New Zealand, Middle East, Eastern Europe, and Africa, did not provide clear information on their performance. The high-growth markets also showed mixed results, with Latin America experiencing mid-single-digit increases in sales, while China saw low single-digit increases. Overall, the data suggests that developed markets and certain product segments were the standout performers in 2025. Management is optimistic about the company's outlook, citing a strong market position and diversified portfolio as key drivers of growth. The company aims to expand its addressable market through investments in commercial organization, R&D, and software and digital solutions. Management believes that the business model supports a strong margin profile with limited capital expenditure requirements and attractive cash flows. The company is positioned to support customers addressing global challenges, particularly in water quality and product innovation segments. Growth will be driven by positive secular trends, and management expects the company to continue growing globally in 2026. However, management also acknowledges areas for improvement, including decreasing operating profit margins due to incremental costs and sales growth initiatives. Management is aware of potential risks to the business and financial statements, including cyberattacks, data breaches, product defects, and government investigations. The company has sufficient liquidity to invest in existing businesses, consummate strategic acquisitions, make interest payments, and manage its capital structure on both short and long-term basis. Overall, management's outlook is positive, with a focus on disciplined commercial execution and leveraging technology to drive growth and improvement. The company has made several significant acquisitions and divestitures over the past few years. Acquisitions have been a key part of the company's growth strategy, with notable deals including the purchase of Insidu, Inc. for $427 million in January 2026. Additionally, the company acquired intangible assets worth an unspecified amount and engaged in multiple business acquisitions without disclosing specific numbers or values. The product quality and innovation segment has also seen significant investments, with attributable sales increasing by $243 million in 2024 and $23 million in 2025. On the other hand, the company has also undergone divestitures, including a separation from Danaher Corporation on September 30, 2023. This move resulted in a net increase of reported sales by 0.1%. Furthermore, the product quality and innovation segment saw a decrease in attributable sales due to divestitures, with $2 million lost in 2025. VERALTO Corporation has a history of rewarding its shareholders through dividend payments and share buybacks. The company has paid dividends in recent years, with notable payments made in 2025, $109 million, and 2024, $89 million. However, there was no dividend payment in 2023. In addition to paying dividends, VERALTO Corporation has also implemented a share repurchase program. In November 2025, the company authorized up to $750 million of common stock buyback, demonstrating its commitment to returning value to shareholders through strategic investments in its own shares. Supply chain concerns loom large. The current state of global trade is marred by several factors that pose significant risks to supply chains. One major concern is the volatility in oil and gas prices, coupled with global instability, which can lead to disruptions in the flow of goods. The imposition of tariffs by the U.S. government and retaliatory measures from other trading partners further exacerbate these issues. Uncertainty surrounding the duration and impact of these trends adds to the complexity of supply chain management. Moreover, catastrophic events such as fires, floods, cyberattacks, and natural disasters can have devastating effects on supply chains. Climate change and sustainability matters also pose a significant threat, with physical risks from extreme weather patterns like hurricanes, tornadoes, wildfires, and flooding. Disruptions in supply chains are not limited to external factors. Internal issues such as supplier capacity constraints, transportation problems, and fluctuations in demand can also cause significant disruptions. These concerns highlight the need for companies to be proactive in managing their supply chains and mitigating potential risks. That concludes the financial summary for VERALTO Corporation. Feel free to comment below, and I will be happy to answer them when possible.